Hey everyone, welcome to this explainer. Today we're going to unpack the hidden financial plumbing that's actually funding this massive AI boom. We'll be drawing heavily on the cutting-edge deep research of Dr. Yogesh Malhotra, specifically his work across the Smart Finance Matters R&D portfolio. We're going to explore how his post-AI quantum theories on model risk arbitrage can quite literally save us from predictable catastrophic failures and help engineer assured outcomes. Now, if you've been watching the markets, you already know artificial intelligence is driving just unprecedented investment. But beneath the shiny surface of new chatbots and generative models, there's a really complex, highly leveraged web of Wall Street structured finance. So today we're exploring exactly how AI compute power is being securitized, the hidden risks threatening the entire system, and most importantly, how to build true resilience. Okay, here's our quick roadmap. We'll cover the AI finance gold rush, ask if CCOs are the next CDOs, examine the danger of model risk, define Knighterian uncertainty, compare backward versus forward AI, and finally, look at engineering assured outcomes. Let's get right into it.
Section 1. The AI Finance Gold Rush, Capitalizing the Future. $1.25 trillion. I mean, that is just a mind-boggling number. It represents the recent surge in hyperscaler AI capital expenditure. The race for AI supremacy has created an unprecedented tech gold rush. But think about it. Building these massive data centers and hoarding high-performance GPUs requires astronomical amounts of cash. Traditional corporate borrowing simply isn't enough to sustain this kind of pace. So the financial system is finding entirely new ways to capitalize, collateralize, and leverage the future demand for compute power.
To actually fund this $1.25 trillion boom, Wall Street engineers introduced a fascinating new instrument known as Collateralized Compute Obligations, or CCOs. These are highly specialized structured finance vehicles. So instead of being backed by mortgages or corporate loans, they repackage AI infrastructure debt. We're talking massive pools of graphics processing units, cloud compute contracts, and data center leases, all bundled into tradable securities. It's a brilliant way to offload financing risk to capital markets, sure, but it introduces a completely new set of vulnerabilities.
Which brings us to Section 2, CCOs, the next CDO, repackaging tech hardware risk.
Just like the traditional debt tranches engineered on Wall Street, CCOs tier risk into different layers. You have the senior notes with the lowest risk and the first claim on cash flows, moving down to the mezzanine, and finally, the highly vulnerable equity pieces at the very bottom which absorb losses first. Wall Street is essentially taking raw, highly volatile tech hardware risk and channeling it based on investor appetite. They're trying to manufacture highly rated investment-grade securities out of depreciating tech assets.
And right here is where we find a massive, glaring vulnerability. The stark contrast is obsolescence risk. Look back at the 2008 CDOs. Those were backed by houses, right? Durable, physical assets that generally hold inherent long-term value. But 2026 CCOs are backed by rapidly depreciating tech. High-performance GPUs face incredibly aggressive tech cycles. New architectures come out and basically make older ones obsolete every 12 to 18 months. You aren't just betting on a borrower paying you back, you're betting that a literal piece of silicon won't be utterly worthless in 2 years.
But wait, it gets even more complex. When you add credit default swaps, or CDS, to the mix, the danger literally multiplies. A CDS is basically insurance against a CCO defaulting. The real threat, though, comes from naked CDS. This is where investors place speculative bets against these assets without actually owning the underlying CCOs. We saw this exact dynamic play out with AIG back in 2008. If the market turns, these unanchored derivative bets run the risk of amplifying a localized tech default into a massive, system-wide financial contagion.
Section 3. The danger of model risk. Flawed assumptions.
Let's look under the hood at the model risk itself. Current rating structures are relying on historically unproven models. For example, a lot of these models assume a 60% or higher recovery rate if a borrower defaults and they have to liquidate the GPUs. But what if those GPUs are already obsolete? That recovery rate could easily be near zero. Plus, there is extreme concentration risk. Roughly 70% of AI GPUs are made by a single vendor, NVIDIA, and almost all the demand relies on a handful of hyperscalers like Microsoft, Google, Meta, and Amazon. If their capital expenditure slows down even a bit, or if a new chip architecture suddenly dominates, the models completely fall apart, potentially wiping out entire tranches of these securities practically overnight.
Section 4. Understanding Knighterian uncertainty, the post-AI framework.
I love this quote from Frank H. Knight because it perfectly captures the core problem Dr. Malhotra addresses in his model risk management frameworks. Wall Street is using probabilistic models to measure risk, basically assuming they can predict the future based on the past. But the AI infrastructure boom and the incredibly rapid pace of technological change actually operates in an environment of true, unmeasurable Knightian uncertainty. You simply cannot accurately model the depreciation of a GPU when the very technology shaping its future hasn't even been invented yet.
Section 5. Backward AI versus forward AI, the ultimate paradigm shift.
So look at the current state of the art, what Dr. Malhotra calls backward AI. Today's generative AI and large language models rely strictly on historical data and statistical pattern matching. But in a world of radical, discontinuous change, historical patterns trail reality by decades. If we rely on backward AI to manage CCO risk, it's going to lead to predictable, catastrophic failures. Forward AI, on the other hand, shifts the focus entirely to causation and the anticipation of surprise. It is explicitly designed to thrive on dynamic adversarial uncertainty rather than just predicting known distributions. This is exactly how we advance from predictable catastrophic failures to assured outcomes.
Section 6. Engineering assured outcomes, mitigating systemic risk. Dr. Malhotra's answer to this lies in QASNs, Quantum Augmented Self-Adaptive Networks. By adopting these advanced frameworks, enterprises can execute true model risk arbitrage. They transition from simply trying to process historical data faster to actually mastering adversarial adaptation. Instead of just optimizing for token generation, you're optimizing for tangible, assured ROI. It's really all about building intelligence capable of acting decisively when the underlying conditions of the market, things like hardware valuations or hyperscaler demand, shift violently and without warning.
So for investors, traders, and risk managers navigating this current market, here are the actionable due diligence steps you absolutely must take right now. First, avoid those high-risk CCO equity tranches. Obsolescence will wipe them out first, guaranteed. Second, you have to separate the cash flow dependency from the residual value of the hardware when underwriting. Third, closely monitor CDS spreads. They act as a crucial early warning signal for market sentiment. And finally, when you stress test your portfolios, don't just plan for a total collapse. Test for what happens if AI growth merely decelerates by 30%. You must decouple the tightly wound combination of technology demand, collateral values, and counterparty credit. I want to leave you with this final critical thought to consider as the AI infrastructure boom fundamentally rewrites the rules of structured finance. We are standing at a major crossroads here. The financial system is capitalizing the exact same AI growth expectations multiple times over, from customer contracts to hardware valuations to structured securities and derivatives. If we continue to rely on backward-looking risk models to govern this future, we leave ourselves utterly exposed to Knightian uncertainty. But if we adapt, if we embrace the principles of forward AI and actually engineer our systems for assured outcomes, we can navigate this dynamic complexity. Think critically about where your risk truly lies. To explore these concepts deeper, including the transition to forward AI, definitely look into Dr. Malhotra's research across the Smart Finance Matters network. Thanks for joining me on this explainer, and keep questioning the models.